Impact of anticipated 30% increase in cross-border investment in technology, agriculture and defense sectors by mid-2025, analyzing the competitive edge against global markets amid U.S. China tensions. Executive summary. By mid-2025, a 30% surge in cross-border investments in technology, agriculture and defense is anticipated, significantly influenced by the ongoing tensions between the United States and China. This report delves into the implications of this investment increase, particularly on the technology sector, where American firms are challenged by competitive Chinese alternatives. The analysis covers key trends, market dynamics, and the role of central banks, providing insights into how nations are adapting their investment strategies amid geopolitical uncertainties. 1. Introduction. The ongoing U.S. China tensions are reshaping the global investment landscape. As countries strive to bolster their economic resilience and technological capabilities, a significant increase in cross-border investments is expected in critical sectors. This report analyzes the anticipated 30% rise in investments, focusing on technology, agriculture, and defense, while discussing the broader implications for global markets. 2. Key trends and developments. 2.1 Technological competition. The technology sector is at the forefront of the U.S.-China rivalry. Recent developments highlight the emergence of Chinese firms, particularly in artificial intelligence (AI). DeepSeek, a Chinese startup, has introduced a cost-effective AI assistant that poses a significant threat to U.S. tech giants like NVIDIA. This advancement illustrates how lower operational costs can empower Chinese companies, compelling U.S. firms to innovate rapidly to maintain their market positions. 2.2 Investment patterns. The expected increase in cross-border investments will not be confined to technology alone. Agriculture and defense sectors are also poised to benefit as nations aim for self-sufficiency and reduced dependency on foreign technologies. This diversification strategy is a direct response to geopolitical tensions, with countries seeking to secure their supply chains and enhance domestic capabilities. 2.3 Market dynamics. Despite the resilient performance of U.S. equity markets, volatility remains a concern, especially within the tech sector. Recent market fluctuations have been driven by mixed economic indicators and inflationary pressures. The upcoming earnings reports from major tech firms, including Apple and Meta, are critical to gauging the sector's health amidst these challenges. 2.4 Central bank policies. The role of central banks in shaping investment landscapes cannot be overlooked. With the Federal Reserve expected to maintain current interest rates, its guidance on future monetary policy will be closely monitored by market participants. Any shifts could significantly impact investment flows and overall market stability. 2.5 Global market impact. The projected investment increase is not solely a reaction to U.S.-China tensions, but also reflects a broader recognition among nations of the need to invest strategically. Countries are increasingly collaborating with others that share similar economic interests, particularly in technology and defense, to enhance their competitive positions globally. 3. Timeline of key events. Mid-2025, anticipated 30% increase in cross-border investment in technology, agriculture, and defense. January 2025, DeepSeek's AI technology gains traction, causing a sell-off in U.S. tech stocks. January 2025, U.S. markets react negatively to mixed economic signals and earnings reports, leading to increased volatility. 4. Common themes and differences. While there is consensus on the significant impact of U.S.-China tensions on investment trends, perspectives vary on which sectors will be most affected. Some analysts emphasize the urgency in the tech sector, while others highlight the importance of agriculture and defense investments. The overarching theme remains clear: nations are adapting their investment strategies to navigate geopolitical uncertainties. 5. Conclusion. The anticipated increase in cross-border investment serves as a reflection of the complex interplay between technological innovation, market dynamics, and geopolitical strategies. as nations respond to the U.S. China tensions. Their investment approaches will be pivotal in shaping the future landscape of global markets. The next few years will be critical in determining how these investments influence competitiveness across various sectors. 6. Sources and references. 1. IG International. 2025, Momentum Compass January 27, 2025, U.S. tech takes big hit amid cheaper China AI competition. Retrieved from IG https://www.ig.com/n/news/trade-ideas/momentum compass 27-01-2025 US tech takes big hit amid cheaper 250127. This report provides a comprehensive analysis of the anticipated investment increase, emphasizing the need for strategic adaptation in response to geopolitical challenges. The evolving dynamics of global markets necessitate a keen understanding of the implications for various sectors, particularly technology, agriculture, and defense. The anticipated 30% increase in cross-border investments in technology, agriculture, and defense sectors by mid-2025 is a notable projection, particularly given the backdrop of U.S. China tensions. This situation not only highlights the competitive dynamics between the two global powers but also reveals counterintuitive trends in investment behavior and market responses. Counterintuitive insights. 1. Cost efficiency over investment scale. One of the most striking counterintuitive elements is the notion that successful technology development does not necessarily correlate with high investment costs. The rise of the Chinese AI startup DeepSeek, which offers a cost-effective AI assistant, challenges the prevailing belief that significant financial resources are vital for innovation in advanced technologies. Many investors typically assume that leading tech firms like NVIDIA maintain dominance due to their substantial R&D budgets and advanced infrastructure. However, DeepSeek's success indicates that efficiency and strategic innovation can allow smaller players to disrupt established giants, thereby reshaping competitive landscapes without the need for equivalent financial backing. 2. Resilience amid tensions. Despite the escalating U.S. China tensions, U.S. equity markets have shown unexpected resilience, reaching record highs. This resilience contradicts the common assumption that geopolitical conflicts invariably lead to market downturns. Investors appear to be compartmentalizing the risks associated with these tensions, focusing instead on strong corporate earnings and economic indicators. The dichotomy between market performance and geopolitical risk suggests a complex investor psychology that may overlook broader risks in favor of short-term gains or sector-specific opportunities. 3. Diverse sectoral growth. While the focus is often on technology due to its high visibility and rapid growth, the anticipated surge in cross-border investment also highlights agriculture and defense sectors. This diversification is counterintuitive in the sense that it challenges the narrative of technology being the sole driver of economic growth in the face of competition. The recognition of agriculture and defense as critical sectors underlines a strategic shift towards self-sufficiency and resilience in supply chains, particularly as nations are realizing the importance of food security and national defense capabilities amidst global uncertainties. 4. Investor sentiment and volatility. The ongoing volatility in tech stocks, particularly following the emergence of cheaper alternatives from China, might seem to indicate a bearish sentiment overall. However, this volatility can also be interpreted as a healthy market correction, wherein investors recalibrate their expectations and valuations based on emerging threats and competitive dynamics. The market's ability to recover and reach new highs despite these fluctuations demonstrates a robust underlying confidence in the long-term potential of the technology sector, which contradicts the notion that volatility inherently signals weakness. 5. Central bank influence. The role of central banks in this investment scenario is noteworthy and somewhat counterintuitive. While one might expect that rising tensions and market volatility would compel central banks to adopt more aggressive monetary easing policies to stimulate the economy, the current outlook suggests a cautious approach instead.
The Federal Reserve's reluctance to cut rates in the face of mixed economic signals and inflationary pressures indicates a belief in the underlying strength of the economy,
which runs counter to the fear-driven narratives often prevalent in times of geopolitical stress.
Conclusion: the anticipated 30% increase in cross-border investment reflects a complex interplay of factors including technological innovation, shifting market dynamics, and strategic geopolitical responses. The insights drawn from this scenario highlight several counterintuitive realities, where cost efficiency trumps high investment market resilience, defies geopolitical tensions, and diversification across sectors becomes a strategic imperative. As nations navigate this evolving landscape, the ability to adapt investment strategies will be crucial in maintaining competitive advantages in a rapidly changing global market. The anticipated 30% increase in cross-border investment in technology, agriculture, and defense sectors by mid-2025 serves as a critical indicator of shifting global dynamics amid U.S. China tensions. While many observers may focus primarily on the obvious implications for the technology sector, there are several nuanced aspects of this report that are likely to be overlooked but hold significant importance for a comprehensive understanding of the investment landscape. 1. The role of cost efficiency in technology innovation. One of the most striking developments highlighted in the report is the emergence of cost-effective technologies, particularly from Chinese startups like DeepSeek. The startup's ability to develop a competitive AI assistant at a fraction of the cost typically associated with such technologies demonstrates a paradigm shift in competitive advantage. This trend raises crucial questions about the sustainability of U.S. tech companies' dominance, especially those heavily invested in high-performance hardware and software. Significance: this cost efficiency not only disrupts the existing market dynamics but also compels U.S. companies to rethink their investment strategies. The ability of Chinese firms to deliver advanced technologies at lower prices may lead to a re-evaluation of R&D budgets and operational strategies within U.S. firms, potentially stifling innovation in the long term. 2. Geopolitical implications of increased investment in agriculture. While much attention is given to technology and defense, the anticipated growth in agricultural investments is critical. Nations are increasingly recognizing the importance of self-sufficiency in food production, particularly in light of supply chain vulnerabilities exposed by recent global events. Significance: the focus on agriculture signifies an understanding that national security extends beyond military capabilities to include food security. As nations invest more in this sector, we may see shifts in trade policies, agricultural technologies, and international alliances. This could fundamentally alter global agricultural markets and influence global food prices, which is a concern that often goes unnoticed. 3. Impact of central bank policies on investment flows. The report mentions central banks' roles in shaping the investment landscape, particularly in the context of the Federal Reserve's monetary policy. With no immediate rate cuts anticipated, the implications for investment flows and market stability are significant. Significance: central banks are often viewed as reactive entities, but their policies can have profound effects on long-term investment strategies. A stable interest rate environment may encourage more aggressive investments in emerging sectors, while uncertainty could drive capital into safer assets. Overlooking the nuances of how monetary policy interacts with market dynamics could lead to misguided investment decisions. 4. Cross-sector collaboration as a strategic response. The report notes that countries are likely to enhance collaboration in strategic sectors like technology and defense. This collaborative approach is often overshadowed by competitive narratives between the U.S. and China. Significance: increased collaboration among nations that share economic interests can result in significant advancements in technology and defense capabilities. This could lead to the formation of new alliances that may alter the global power structure. Understanding these collaborative efforts is crucial for anticipating future geopolitical shifts and investment opportunities. 5. Volatility in U.S. equity markets and its broader implications. The report highlights the resilience of U.S. equity markets, yet it also points to pronounced volatility, particularly in tech stocks. The potential sell-off triggered by the rise of cheaper alternatives like DeepSeek indicates a broader fragility in the market which might be overlooked as investors focus on short-term gains. Significance: this volatility is a reminder of the interconnectedness of global markets. A downturn in U.S. tech stocks could have ripple effects across various sectors both domestically and internationally. Investors should consider the systemic risks associated with reliance on a few dominant players and the potential for broader market instability. 6. The future of U.S. China relations and investment strategies. The ongoing tensions between the U.S. and China are a backdrop for the anticipated investment surge. However, the report suggests that nations are adapting their investment strategies in response to these geopolitical uncertainties. Significance: the evolving U.S. China relationship will likely dictate future investment flows and strategies. Understanding the potential for both cooperation and conflict is essential for investors looking to navigate these complex waters. Overlooking this aspect could lead to missed opportunities or increased risks in investment portfolios. 7. Market sentiment and psychological factors. The report indicates that mixed economic signals are influencing investor sentiment, which can often be overlooked in favor of quantitative data. The psychological aspect of investing, how fears and expectations shape market behavior, can be just as impactful as fundamental economic indicators. Significance: market sentiment can drive prices more than actual performance metrics, leading to cyclical patterns of boom and bust. Investors should be aware of the psychological factors at play and consider how these emotions could influence market movements, especially in volatile sectors like technology. 8. Diversification of supply chains. The report discusses the diversification of supply chains as nations seek to reduce dependency on foreign technology. This is increasingly significant in the context of U.S. China tensions as countries strive for greater autonomy. Significance: a diversified supply chain can enhance resilience against geopolitical risks but may also lead to increased costs and inefficiencies in the short term. Investors should consider the long-term implications of these shifts on global trade patterns and the associated investment opportunities in domestic industries. Conclusion: the anticipated increase in cross-border investment amidst U.S.-China tensions offers a rich landscape for analysis. While mainstream discussions may center on immediate impacts in technology and defense, the significance of overlooked elements such as cost efficiency, agricultural investments, central bank policies, cross-sector collaboration, market volatility, geopolitical dynamics, psychological factors, and supply chain diversification cannot be understated. Recognizing these factors will equip investors and stakeholders with a more comprehensive understanding of the evolving global investment environment. 1. Technological competition and market disruption. The rise of Chinese technology firms, particularly in artificial intelligence (AI), poses a significant challenge to established U.S. companies. The emergence of cost-effective alternatives such as DeepSeek's AI assistant illustrates how lower operational costs can disrupt market dynamics. This trend highlights the need for U.S. firms to innovate aggressively to maintain their competitive edge and market share. The implications of this competition extend beyond immediate financial impacts, potentially reshaping the global technology landscape. 2. Investment patterns in strategic sectors. The anticipated 30% increase in cross-border investment signals a strategic pivot by nations toward technology, agriculture, and defense sectors. This shift is driven by a desire for self-sufficiency and resilience in supply chains amid geopolitical tensions. As countries diversify their investments and reduce reliance on foreign technologies, the global investment landscape may witness increased collaboration among nations with similar economic interests, particularly in technology and defense sectors. 3. Market dynamics and economic signals.
The mixed signals from U.S. equity markets, including the resilience of indices like the S&P 500 juxtaposed with volatility in tech stocks, reflect investor sentiment amid economic uncertainties. Factors such as inflation concerns and upcoming earnings reports from major tech firms will play a crucial role in shaping market behavior. Investors are likely to recalibrate their expectations based on these developments, impacting future investment flows and market stability. 4. Central bank policies and their influence on investment. The role of central banks, particularly the Federal Reserve, is pivotal in shaping the investment climate as cross-border investments increase. With no immediate rate cuts anticipated, the Fed's guidance on future monetary policy will be closely monitored by investors. Central bank decisions can affect liquidity, risk appetite, and overall market stability, influencing how investments are allocated across sectors, especially amidst ongoing U.S. China tensions. These points collectively underscore the complex interplay of technological innovation, geopolitical strategies, market dynamics, and monetary policy that will shape the future of global investments in the face of evolving international relations. 1. The Cold War and the Space Race. 1947 to 1991. The Cold War era was marked by intense geopolitical tensions between the United States and the Soviet Union. A significant aspect of this rivalry was the space race, a competition in technological advancements, particularly in space exploration. The launch of Sputnik by the Soviet Union in 1957 triggered a series of events that led to massive investments in technology and education in the U.S., ultimately resulting in the Apollo moon landing in 1969. This period exemplifies how geopolitical tensions can lead to increased investment in critical sectors as nations strive to maintain competitive advantages. 2. Japan's economic rise in the 1980s. During the late 20th century, Japan experienced a significant economic boom characterized by rapid advances in technology and manufacturing efficiency. This period saw Japanese companies like Sony and Toyota emerging as global leaders, which led to concerns in the U.S. about job losses and competitiveness. In response, the U.S. government and businesses increased investments in technology and strategic industries, aiming to regain market dominance. The competitive pressures between Japan and the U.S. during this time illustrate how cross-border investments and innovations can be influenced by national security and economic competition. 3. The European Union's Common Market. 1957-present. The establishment of the European Economic Community (EC), later the European Union (EU), aimed to foster economic integration among European nations. The EEC's creation was partly a response to post-World War II tensions and the desire for stability in Europe. By facilitating cross-border investments and trade, the EU has significantly impacted sectors such as agriculture and technology. The common market allowed for increased collaboration and competition among member states, showcasing how regional tensions can lead to strategic alliances and enhanced economic cooperation. The anticipated 30% increase in cross-border investment in the technology, agriculture, and defense sectors by mid-2025 is expected to reshape the global investment landscape significantly, particularly in the context of the ongoing U.S. China tensions. This surge in investment reflects broader trends in geopolitical strategy, innovation, and market dynamics, revealing the competitive edges that nations and companies must navigate in a rapidly evolving global market. Predictions for the future. 1. Technology sector disruption. The rise of cost-effective Chinese technology firms, exemplified by startups like DeepSeek, could lead to significant disruptions in the U.S. tech market. As these firms leverage lower operational costs to innovate and provide competitive products, major U.S. tech companies may face increasing pressure to adapt their strategies. This could manifest as a shift towards more cost-efficient operations, increased investment in research and development, and potentially more aggressive pricing strategies to retain market share. 2. Investment diversification. The projected increase in cross-border investment will likely encourage countries to diversify their portfolios beyond traditional strongholds. Expect to see greater investment in agriculture and defense sectors as nations strive for self-sufficiency and resilience against supply chain vulnerabilities highlighted by geopolitical tensions. Countries may prioritize investing in domestic agricultural technologies and defense innovations to mitigate risks associated with reliance on foreign entities. 3. Geopolitical alliances. As nations reassess their investment strategies, we could see the formation of new geopolitical alliances centered around shared economic interests. Countries that align on technological development, agricultural sustainability, and defense capabilities may engage in deeper collaborations, sharing resources, knowledge, and strategies to strengthen their competitive positions. This could lead to the emergence of regional tech hubs and collaborative platforms that foster innovation. 4. Increased market volatility. The ongoing U.S. China tensions and the rise of competitive alternatives will likely contribute to increased volatility in global markets, particularly within the tech sector. Investors may react strongly to emerging competition, leading to rapid shifts in stock valuations. Major earnings reports, especially from significant players like Apple and Meta, will be closely scrutinized for insights on market health and future trends. 5. Central bank influence. Central banks will play a crucial role in shaping the investment landscape amid rising cross-border investments. As the Federal Reserve and other global monetary authorities navigate inflationary pressures and mixed economic signals, their policies will likely influence liquidity and investment flows. Market participants will be keenly attuned to any indications of future rate cuts or policy shifts, which could either foster or hinder investment growth. 6. Sustainability and ethical investments. As the global investment landscape evolves, there will be a growing emphasis on sustainability and ethical investing. Investors are increasingly seeking opportunities that align with environmental, social, and governance (ESG) criteria. This trend could lead to a greater focus on sustainable agricultural practices, green technology innovations, and ethical defense technologies, reshaping investment strategies across sectors. 7. Rise of alternative technologies. The competition with Chinese firms may spur U.S. companies to explore alternative technologies and innovations that can offer superior performance or efficiency. This includes advancements in quantum computing, renewable energy technologies, and biotechnology. The race for technological supremacy will likely fuel investment in these emerging areas, creating new opportunities and challenges for global investors. 8. Impact on supply chain resilience. The anticipated increase in investment will likely drive efforts to enhance supply chain resilience. Companies may prioritize local sourcing and manufacturing to reduce vulnerability to geopolitical disruptions. This shift could lead to increased investments in domestic production capabilities and technologies that support supply chain transparency and efficiency. Conclusion. The projected 30% increase in cross-border investment by mid-2025 reflects a complex interplay of geopolitical dynamics, market competition, and technological innovation. As nations and companies navigate the challenges posed by U.S. China tensions, the future landscape of global investments will hinge on strategic adaptations in technology, agriculture, and defense sectors. The evolving competitive environment will necessitate agility, collaboration, and a forward-thinking approach to seize opportunities and mitigate risks in this new era of investment.